Our first official panel today is entitled Non-Bank Lending, Why This Alternative to Fixed Income Continues to Be Compelling. The moderator for this panel is Jeananne Cameron, who is the Chief Investment Officer at Reddick Wellington Investments. Welcome, Jeananne. I don't know. Oh, here they come. I didn't even notice. I'm introducing them.
How you doing?
Nice to meet you in person. Nice to see
Okay.
Hello. As Karen just said, my name is Jeananne Cameron. I'm Chief Investment Officer of Reddick Wellington, which is a large single-family office based out of Toronto. We invest in a number of different things. We are big believers in mortgage funds, and I am very lucky here to have today on the panel Rob Goodall, who's the President, CEO, and founder of Atrium MIC and CMCC High Yield MIC. Lisa Stewart, who is the Chief Revenue Officer at Neighborhood Holdings, and Sandy, is it Poklar or Poklar?
Poklar.
Poklar, COO and Managing Director of Firm Capital Corp. To start off with, I'd love each of you to sort of introduce your funds.
Sure.
If you could. That'd
Sure.
be great.
So my name, for Firm Capital Asset Management Corp, or Firm Capital Corporation, we're a real estate asset management firm located here in Toronto. We manage approximately $5.5 billion of assets, all in real estate related debt and equity securities, both publicly and privately traded. We manage 3 public companies, as well as a series of RRSP funds and RSP funds, as well as a number of private mix as well and private real estate funds. Everything that we do, predominantly the vast majority of our portfolio within the mortgage space is largely residential. 95% of the portfolio today I would deem to be residential. On the real estate side, we own and manage approximately 5 million square feet of retail, another 8 million square feet of industrial, and approximately 4,500 apartment units both here in Canada and the U.S. We lend, and on our lending side, we also lend in both Canada and in the U.S.
Okay, Lisa?
Hi, I'm here from Neighborhood Holdings. We are an alternative residential mortgage fund based in Vancouver. We lend to individuals buying homes across Canada. These homes are located in urban and suburban areas, and our target market is borrowers who are just temporarily unable to access bank financing. So we manage about $360 million today. We are a levered fund, so that's an important part of our strategy. We were initially founded as part of a strategy in a family office, and were spun out in 2015 to take advantage of opportunities in the Canadian mortgage space. And so we've grown today to, as I mentioned, $360 million.
And Rob?
Hi, I run a company called Canadian Mortgage Capital Corporation. We have about $1.8 billion under management, and about 3/4 of that is debt related. The other is real estate related. In the debt area, we have 3 different platforms, a low risk area that we manage for a couple of pension funds and wealthy families, a high yield MIC, which is private, that we just started a couple of years ago, that probably never will be very large, but is targeting at about a 10% annual dividend. And then the engine to our company is Atrium, which is the public entity, which has about $800 million of assets and has been around for about 21 years.
Okay. And so, Sandy and Rob both have public funds and Lisa a private one. Could you just walk us through, maybe Rob, because you've got both private and public, the benefits of being a public fund compared to a private one?
Yeah, there's benefits to both. Atrium, I mentioned, is 21 years old, but the first 11 years it was private, and the last 10 it's been public. And for the most part, in the first 11 years when we were private, it was fine. And then 08-09 hit, we incurred 0 losses and had 25% redemptions. And it was almost like we were a victim of our own success because we were continuing to pay dividends, because we were allowing exiting shareholders to leave the fund at book value, which was what they came in at. They were using that to offset margin calls and liquidity issues on the rest of their portfolio. And so for a company the size of Atrium, I didn't really want to go through that again. So we decided in 2012 to take it public. And the value of a public company is liquidity for the shareholders, but it's also the permanence of the capital. It's really valuable, possibly over the next 6 months, when a lot of the private mix may be facing redemptions, not necessarily because they've done anything wrong, but because clients are nervous or shareholders are nervous and they want their money back. And so the three public mix, there's only three, may have an advantage because they have the permanent capital. Having said that, as Sandy knows, there were once upon a time 6 public mix, and 3 of them didn't really make it. So you better run your company well if you're public, or else you're gonna face the music.
And how large do you think you have to be in order to go public? What's the right amount of assets under management?
So when we went public in 2012, it was viewed as 200 to 300 million. I imagine that number's larger now because your overhead really is going to be $1 million for sure.
If I may interject here, I think part of it is the equation as to whether or not you want to be listed on the TSX versus the venture exchange.
Oh, true.
Right, and I think if you're looking for a broad institutional dynamic out of the gate, then you want to be on the TSX, and to Rob's point, you want to have a larger market cap, obviously. That being said, our MIC, when it went public in '99, only had about $25 million of shareholders' equity. But given the cost increases that have occurred over time on the public side, if you're anything under $100 million of market cap, you're better off being on the venture exchange for a variety of reasons. And as having been an issuer on both exchanges and having just graduated my Canadian REIT recently, I can tell you there's a cost inflection point at around $200 million of market cap, where the costs of being on the venture exchange are indifferent as to whether or not you're being on the big board as well. And so I would argue that if you want to be listed, you're focused on retail, and you have a great product, but you don't have the market cap or the size, go on the venture exchange. It's a great place to be listed. I swear by that. That being said, if you are looking for a broader dynamic, which includes institutions, go on the big board, but don't come for less than 150 to 200 million.
Okay. Let's talk a little bit about market size. What is the market size of the non-bank mortgage lending? I think I'm going to ask Lisa that question because we talked about it before.
I used to work at RBC, so I tend to use RBC numbers. I think the Canadian mortgage space in total is about 1.6 trillion. Banks take up about 92% of that space, so 92% of Canadians can go to a bank and get a mortgage. If you can't go to a traditional bank, you might be pushed into the B space, which would be your home cap, equitables. Those take up about 5% of the market, or maybe 6%. So then that leaves us at 98% of the market being in the A and B space. We'd estimate our space to be about 2% of the market, so about 25 billion. Those numbers do fluctuate. It is hard to estimate because our space has quite a wide range in terms of lenders. It's everyone from the individual who's willing to lend someone, a few $100,000 to buy a home, to some of the more institutional players in the space. But today, I'd estimate it to be about 25 billion.
Okay.
And in Ontario, I think in Ontario, the regulator broke out between syndicated mortgages and mix, and I was sort of shocked to see the size of the syndicated portfolio. It's almost as big as the total mix space.
Yeah. I actually read in the Globe today that there is more regulation coming out to sort of restrict the syndicated space. So the individuals who are lending money, they're trying to put more regulation into that space to, I guess, control the types of transactions that are happening there. So putting more restrictions on brokers.
Okay. So obviously, the big topic of today is inflation. How will inflation affect the underlying assets and the funds? And does it worry you about, what's sort of happening in the marketplace right now? And
Sure.
Let's start with Sandy.
So I'll answer that question in reverse. Inflation does worry us to an extent. We've been concerned about this inflationary environment for a number of years, particularly on the rising costs of homes themselves, as well as the cost of materials over the last few years. So our primary focus has been to focus on the residential space, focus on single-family homes. So if you look at our portfolio today, it's $1.5 billion across our various platforms, but the average loan size is only about $1.5 million. So it's 1,000 loans that we manage, and the average profile of a borrower is your mom and pop developer who ties up a parcel of land somewhere in the GTA. They tear down the existing home, they rebuild it with a new home. We finance them with the land costs, the construction costs, and then they take us out later by either refinancing with a Canadian bank on a first mortgage, or they sell the underlying asset and they pay us back that way. So getting back to the question, what we've been doing to managing that risk has been doing lower LTV deals, number one, focusing on what our exit strategies are, focusing on the residential space. And in getting back to your question about inflation and how we've been hedging ourselves, 95% of our loans internally have a mechanism whereby when we price our deals, we price at the greater of, and it's a formula based on the greater of a floor rate or prime plus a spread. So if interest rates rise and the banks increase prime, we capture the upside. And if they drop rates and they ultimately drop prime, we have a floor rate that we earn a return on. So right now, our book, which is 95% managed in that regard, is benefiting from this rising rate environment, if you will, as a result of it. So we're doing quite well on it. But that being said, we are very conservative on just about every other aspect, given what's going on.
Rob, I'm going to ask you the same question. Are you taking the same sort of tactic as Sandy is in the portfolio?
To some extent. I mean, I am a little worried about the market. I mean, Toronto was up 35% last year, Vancouver up 20%. So you'd sort of be crazy not to be worried as rates move up. I think what you have to do is what you should have been doing all along is keep the loan to value really low. Our loan to value is anywhere from 60 to 61% over the last X number of years, and it's never been over 65. So that means the developer or the real estate investor has 35% equity, and that should allow you a major buffer while your market is in a downturn. I do agree that if you can avoid loan losses, this isn't such a bad environment for us because we don't have 95% of our book priced off of prime. We have about 2/3. On the liability side, we only have 25 priced off of prime. That's our line of credit. Mm-hmm. So theoretically, if you keep your book clean, your dividend should go up.
Yeah, we tend to say that our fund performs well in a rising rate environment because your assets do generate more income with the rising rates. Of course, you have to be concerned with the end borrower and real estate valuations, but something we also tend to say is this is why we're debt investors and not real estate investors, because there is a big buffer before we'd have principal at risk. So the underlying value of the asset we are concerned with if it goes to a foreclosure, but otherwise it's a good way to earn a stable yield through this type of environment.
And what would your loan to value be?
Average across the portfolio today is 58%. So that's something that we watch very carefully, and similar to Sandy, when it's something that we constantly tweak. So in an environment like this, we tend to take risk off and are willing to go or aren't willing to go as high on LTV.
Okay. And I know, Lisa, you're based out of BC, I believe.
Yes.
So there's obviously different market dynamics. Are there areas that you will not touch in Vancouver in terms of maybe condos or detached because you're doing residential? And I'm going to ask the same question as well of Sandy and Rob afterwards.
So we focus on what we would consider to be liquid properties. So to us, that means homes located in urban and suburban areas that demonstrate pride in ownership. So we won't do rural, we won't do bare land, we won't, for us, we're not commercial specialists, so we also won't touch that. In terms of areas of BC, it really just depends on the size of the market there. So we have certain restrictions on population size because we like to ensure that there's a job market, so the person buying the home can move there and get a job, just to ensure that there's more liquidity.